I'm Robin John, and I'm going to talk about the Chancellor's recent autumn 2017 budget. The first thing that I always find interesting is to look at where the money comes from. Here's a rough analysis of the main sources of revenue. The big one is income tax, followed by national insurance and VAT. You then take a big step down to corporation tax. An interesting one here is fuel duties, £27.9 billion. I wonder what's going to happen when we all drive electric cars and how the Chancellor is going to replace that revenue. Also, look at the other taxes, £62.3 billion. Let's look at where that comes from. £4.8 billion from inheritance tax. Given the amount of fuss and attention and focus that inheritance tax gets, it's actually a very small proportion of the government's revenue. £11.9 billion stamp duty land tax, a substantial sum of money. Another interesting figure is where the government spends the money. Here's a rough analysis. Social protection, unemployment benefits, benefits generally, £240 billion. These are primarily amounts of money that the government simply gives people. Far and away the biggest item of expenditure. Health, the next one, £145 billion. Debt interest, £39 billion, almost as much as the government spends on defence. You can see why the government is worried about increasing the level of public sector debt. Not only does it have to be paid back, but for the next few years, you're going to be paying interest on it as well. The tax gap is the government's estimate of the amount of money that it thinks it should have had, but it hasn't had. There's a lot of estimating involved here, but here's where the government thinks it loses money. Failure to take care, £6.1 billion. Legal interpretation, that's where the revenue have one view and the taxpayer has another. Criminal tax, a big number, £5.1 billion. Down the bottom is anti-avoidance, £1.7 billion. Despite all the fuss about tax avoidance, from a tax gap point of view, it's really not a big sum of money. Also, let's look at who the alleged culprits are. SME sector, far and away the biggest. That's probably understandable because that's where the most opportunity arises, both for under declaration and of course for error. Given the complexities of the tax system, I think the average SME company has a great deal of difficulty understanding exactly what it is that it should be doing. But again, criminals, £5.3 billion they're costing the taxpayer. The total, £34 billion, it's a lot of money. 6% of the revenue, but by international standards, that's actually quite low. The UK compares very well with other jurisdictions, even ones that have a reputation for being good at tax compliance, the United States, Scandinavia. Let's look at a few other provisions that are important, although they haven't necessarily hit the headlines. Companies and capital gains tax. Indexation allowances for individuals finished in 2008, but it carried on for companies. That is proposed to end after 31 December 2017, so the base cost of assets will be indexed up to that date, but not thereafter. One of the biggest categories of people that will be affected by this is companies that own residential property portfolios. In recent years, there's been quite a lot of interest in the possibility of transferring residential property portfolios to companies because of the interest restriction rules, so this might make that slightly less attractive. The government's proposing to publish a consultation paper on the possibility of bringing non-UK owners of UK commercial property into charge to capital gains tax in the same way that they did with residential property. Unfortunately, it's a lot more complex with commercial property because the financial arrangements tend to be far more complicated. The proposal is that this starts from 1st of April 2019, and it's probable, given what happened with residential property, that this will only apply to gains arising after that date. In practice, this brings the UK into line with many other jurisdictions that all tax non-residents on disposal of real estate in their country. The government has also said that it's going to look at the taxation of what it calls property-rich assets, primarily companies where the principal asset is UK Citrus real estate. There are changes in store for contractors. A lot of individuals provide their services through a company because this is what the client insists on, because the client doesn't want to find himself with an employee he wasn't expecting to have. There is legislation which is colloquially known as IR35, which changes the tax burden of contractors. Recently, the legislation was changed so that the burden of deciding whether IR35 applies is placed on the customer, where the customer is a public sector company. In practice, most public sector employers simply assume that the contractor is within the provisions and deduct the tax. The government's going to look at extending this to the private sector. So if you are a contractor, now would be a very good time to examine your arrangements to make sure that you're not within IR35 provisions. The disguised remuneration provisions primarily apply to employee benefit trusts. You may have heard recently about the recent case involving Rangers Football Club, where the Revenue were very pleased that they won the case in the Supreme Court. The Supreme Court decided that the payments to the employee benefit trust were taxed at the time that they were made. As a final comment, they said, well, in view of that, the disguised remuneration legislation now becomes irrelevant. I think that upset the Revenue quite a bit because they spent a lot of time writing it. So rather than have it become irrelevant, as the Supreme Court said, they proposed to change the law to specify that it does still apply. In addition, anybody who has taken a loan for an employee benefit trust must report that by the 1st of October 2019, presumably so that the Revenue can make sure that all the tax obligations are complied with. The Enterprise Investment Scheme has been a very successful way of attracting investment into technology and high-risk companies. At the moment, the limit is £1 million, but it's proposed to increase that limit to £2 million for investments in what is called knowledge-intensive companies. As to what is a knowledge-intensive company, unfortunately the legislation runs to about a page and a half, so I'll have to leave you to read that. There's been a lot of focus in recent years on the possibility of both avoidance and evasion of income and gains that arise outside the UK. There is a new provision being introduced which requires anybody who has not paid tax on any income with a non-UK connection to correct that before the 30th of September 2018. If it's not corrected by that date, then afterwards not only will the tax be payable, but the penalty will be between 100% and 200% of the tax, or 150% to 300% of the tax if the taxpayer moves assets to try and keep ahead of HMRC. If income arises after the 6th of April 2017 and the tax is not paid and it has an overseas connection and the tax is more than £25,000 and the taxpayer didn't take reasonable care, then that is automatically a criminal offence. You can get up to 51 weeks in jail, or only 6 months if you do it in Scotland or Northern Ireland, and there is no need to prove that the taxpayer was dishonest or that he intended to avoid his tax. He could have just made a mistake. The defence of that is that you took reasonable care, but unfortunately, taking prohibited advice is not reasonable care. Relying on disqualified advice does not count as taking reasonable care. Advice is disqualified if the advisor is interested in the arrangements, in other words, he gets commission, or he only gets the business if you follow his advice. The advice is not addressed to the taxpayer and specific to his circumstances, or the advisor did not have the qualifications or the expertise to advise. It's no defence to say, and these are all comments that I have heard from people as to why they didn't put their overseas income on their tax returns. The income is already taxed abroad. I don't understand tax legislation, or my bank or IFA didn't mention whatever the relevant section number was. In the future, unfortunately, those excuses will not keep you out of jail. There's a time limit for the revenue collecting back tax. At the moment, it's 4 years if they make a discovery, 6 years if the taxpayer has been careless, or 20 years if he's been deliberate. In future, when that relates to offshore matters, the time limit is 12 years or 20 years if the taxpayer has been deliberate. There's changes in the legislation applying to offshore trusts with effect from the 6th of April 2018. In the future, payments made to a UK resident via a non-resident will be taxed as though the UK resident had received the money directly from the trust, and stockpile gains are no longer washed out by distribution to a non-resident. So if you are a beneficiary of an offshore trust, or you're expecting to be, or you're otherwise involved, it will be a good idea to make any arrangements that would be necessary before the 6th of April 2018, because some things that you could do now will not be possible after that date. And if what I've said means that you now feel inspired to fly off to the Caribbean and sort out your offshore trusts, I'm afraid it's going to cost you a bit more, because long-haul air passenger duty will be increasing. Thank you for listening.